Welcome to CoreDocuments.com, the nation's leading provider of affordable plan documents required by the Internal Revenue Service, Department of Labor, and the Affordable Care Act. In this presentation, we'll review the main tax-saving employee benefit plans that require formal plan documents from Core Documents for legal compliance and proper administration. These plans can help employers reduce payroll taxes, help employees reduce taxable income, and create valuable benefit options that improve overall compensation. We will cover Section 125 Cafeteria Plans, Health Reimbursement Arrangements, WRAP Summary Plan Descriptions, Section 132 Transit and Parking Plans, Section 127 Educational Assistance Plans, and Plan Administration Options. Along the way, we will also explain key compliance rules, tax advantages, design options, and employer considerations. There are several major tax-saving benefit plans that commonly require core documents. At the top of the list is the Section 125 Cafeteria Plan, which can include a premium-only plan, an HSA salary reduction module, a health FSA, and a dependent care assistance plan. There are also several health reimbursement arrangements, or HRA designs, including the one-person Section 105 HRA, the group coverage HRA, the qualified small employer HRA, the individual coverage HRA, and the accepted benefit HRA. In addition, employers may need a WRAP SPD, a Section 132 Transit and Parking Plan, a Section 127 Educational Assistance Plan, and in many cases, a compliant structure for administration, either in-house or outsourced. Let's start with the Section 125 Cafeteria Plan. A Section 125 plan allows employees to pay certain benefit costs with pre-tax dollars. That means employee salary reductions used for qualified benefits can avoid federal income tax, Social Security and Medicare tax, and often state income tax as well. This creates tax savings for both the employee and the employer. The employee keeps more of their paycheck, and the employer reduces payroll tax liability on the amounts elected through the plan. Under Section 125, a cafeteria plan must be a formal written plan. Employees must be offered a choice between taxable cash, regular payroll, and qualified benefits. In practice, this usually means employees may choose to keep compensation as taxable wages or redirect part of that compensation toward eligible benefits on a pre-tax basis. This written plan requirement is critical. Without the formal plan document, insurance premiums and other elections are generally not treated as pre-tax under Section 125. That is one of the most common employer compliance mistakes. A compliant written plan generally includes plan sponsor information, eligibility rules, descriptions of benefits offered, claims procedures, review procedures, plan administration terms, fiduciary or trustee information where applicable, and amendment and termination rights. The key point is simple. Pre-tax treatment is not automatic. The employer must establish the plan correctly in writing. The most common Section 125 arrangement is the premium-only plan, often called a POP. A POP allows employees to pay their share of group health and certain supplemental insurance premiums through pre-tax salary reductions. For employers offering group health insurance, this is often the foundational document needed to convert employee premium deductions from taxable wages into pre-tax deductions. This can apply to group medical, dental, vision, eligible group term life, up to $50,000, accident coverage, cancer coverage, and other eligible insured benefits. The presentation shows that even with one employee, the employer's payroll tax savings can exceed the one-time cost of the plan document package. For example, if one employee pays $200 per month for group health coverage and $25 per month for supplemental benefits on a pre-tax basis, the employer may generate annual payroll tax savings that exceed the document cost in the first plan year. That illustrates one of the biggest selling points of a Section 125 POP. It is often both a compliance tool and a cost-saving tool. A basic POP can be expanded with additional modules to create even more tax savings. These modules commonly include the Health Flexible Spending Account, the Dependent Care Assistance Plan FSA, and the Health Savings Account Salary Reduction feature. A Health FSA allows employees to make pre-tax contributions for eligible out-of-pocket medical expenses. For 2026, the annual contribution limit is up to $3,400. That limit is IRS indexed and generally increases by $100 a year. Employees receive the same pre-tax advantage as under a POP, while employers receive payroll tax savings on those contributions as well. The employer also chooses how year-end balances are handled. Available design options may include a limited rollover, a grace period, or a use it or lose it rule. The employer may also tailor the health FSA to coordinate with HSAs or HRAs. The Dependent Care Assistance Plan, or DCAP FSA, allows employees to set aside pre-tax dollars for eligible dependent care expenses that are necessary for the employee or the employee's spouse to work. The presentation notes that the annual limit increased to $7,500 for married individuals filing jointly, with a lower amount for married filing separately. It also notes that this was the first increase in 40 years. Unlike a health FSA, dependent care reimbursements are generally limited to the balance actually available in the account. An HSA can also work with a Section 125 plan when employees contribute through payroll. The HSA itself is employee-owned, portable, and not subject to use it or lose it rules. But the Section 125 Cafeteria Plan provides an important advantage. It allows employee HSA contributions through salary reduction to receive an extra 7.5% tax savings in Social Security and Medicare taxes, not available if the employee takes the deduction on their year-end tax return. The 2026 HSA contribution limits of $4,400 for individual coverage and $8,750 for family coverage, with an additional catch-up contribution for those over age 55. An HSA must be paired with a qualified high-deductible health plan that meets required deductible and out-of-pocket limits. In summary, the Section 125 Cafeteria Plan is the gateway to pre-tax benefit elections. It starts with the written POP document and can expand to include a health FSA, DCAP FSA, transit, and HSA salary reduction options. For many employers, this is one of the simplest and most effective ways to combine compliance with immediate tax savings. Now let's turn to the Section 127 Educational Assistance Plan, or EAP. This plan allows an employer to reimburse employees up to $5,250 annually for qualified educational assistance. According to the presentation, eligible expenses can include tuition, books, supplies, fees, and even student loan payments. The presentation also notes that the student loan repayment feature, which had originally been scheduled to expire in 2025, was extended indefinitely by the One Big Beautiful Bill Act. This is an employer-funded and employer-administered plan, and it can be a valuable benefit for recruiting, retention, and employee support, while also providing favorable tax treatment. Next, let's review Health Reimbursement Arrangements. HRAs provide tax-free reimbursement of eligible medical expenses under Internal Revenue Code sections 105 and 106. Different HRA designs apply to different employer sizes and benefit strategies. The right structure depends heavily on how many employees are involved and what type of health coverage the employer wants to coordinate with. The one-person Section 105 HRA is designed for a very narrow setting, typically a business owner who is the only eligible employee, or a spouse who is legitimately employed by the business. Because one employee is not treated as a group for ACA purposes, this arrangement historically avoided many of the ACA rules that apply to group plans. The presentation explains that this type of HRA can reimburse a broad range of eligible medical expenses and can create meaningful tax savings for small business owners in the right fact pattern. The Qualified Small Employer, or QSEHRA, is designed for employers with fewer than 50 employees. It allows the employer to reimburse employees for individual health insurance and other eligible out-of-pocket medical expenses, subject to annual limits. The presentation lists 2026 limits of $6,450 for self-only coverage and $13,100 for family coverage. However, a QSEHRA comes with important rules. The employer cannot offer another group health plan to employees. Employees must have minimum essential coverage for reimbursements to be tax-free, and employees must report the QSEHRA to the ACA marketplace, because available QSEHRA funds may reduce premium tax credits. The employer is also required to provide a written notice explaining these rules. The individual coverage HRA is designed primarily for applicable large employers, though the presentation notes that employers of any size may use it. An ICHRA allows employers to reimburse employees for individual market health insurance and other eligible medical expenses. Unlike a QSEHRA, there is no annual statutory reimbursement cap. The presentation also explains an important ACA interaction. An ICHRA can eliminate eligibility for advanced premium tax credits unless the ICHRA is considered unaffordable. It also notes an affordability threshold for 2026. For larger employers, the ICHRA can be part of an ACA compliance strategy, but it must be designed and administered carefully. For employers with 2 or more employees who also maintain a group health plan, the group coverage HRA is another option. This HRA must be integrated with employer-sponsored group coverage. It can be designed to reimburse deductibles, co-pays, co-insurance, dental, vision, prescription expenses, or other eligible out-of-pocket costs. The presentation describes several design variations, including comprehensive integrated HRAs, limited HRAs, deductible gap HRAs, Medicare HRAs, and retiree HRAs. One especially practical design is the deductible gap HRA. Under that approach, the employer may purchase a lower premium, high-deductible group plan, then use HRA funds to reimburse some or all of the added deductible exposure for employees who actually incur claims. That can produce a more efficient overall benefits cost structure. Another critical document discussed in the presentation is the WRAP Summary Plan Description, often called the WRAP SPD. For employers sponsoring group health coverage, this document is a major compliance item. The presentation explains that the WRAP SPD communicates plan rights, obligations, and required notices to employees and beneficiaries. It also emphasizes that insurance carrier materials, such as certificates of coverage or summaries of benefits, are not a substitute for a true WRAP SPD. Failure to provide the WRAP SPD when required can expose the employer to penalties and potential Department of Labor scrutiny. The presentation notes a potential penalty of $110 per day if the document is not provided within 30 days of request. Now let's look at the Section 132 Transit and Parking Commuter Benefit. This plan allows employees to pay eligible parking and transit expenses on a pre-tax basis. The presentation lists 2026 monthly limits of $340 for parking and a separate $340 for transit. These reimbursements are available only after eligible expenses are incurred and paid, and the plan does not follow the Health FSA Uniform Coverage Rule. For employers in areas with significant commuting costs, this can be a practical and appreciated benefit with meaningful tax advantages. Tax-favored benefit plans are not just about documents. They also require proper administration. The presentation explains that, aside from the HSA, most of these arrangements do not require a separate trust or bank account. Funds can generally remain in the employer's general account until reimbursements are due. The employer, or an appointed administrator, must keep records of elections, balances, claims, and reimbursements. Many employers choose to self-administer, while others prefer to outsource administration for convenience, consistency, and privacy reasons. The presentation highlights several reasons employers outsource claims administration. These include convenience, access to participant account tools, debit card functionality, and relief from handling employee-protected health information directly. Outsourcing can also reduce internal administrative burden and improve the employee experience through online access and streamlined reimbursement processes. Employers also have flexibility in how they design these plans. They must establish a plan year, which may be any 12-month period. In the first year, a short plan year may be used. Employers also set employee eligibility rules, such as waiting periods, minimum hours, and eligible classes of employees. For health FSAs, the employer also decides whether to allow a grace period, a limited rollover, or use it or lose it treatment, and may set contribution limits lower than the legal maximum if desired for risk management purposes. Employee elections are another important compliance topic. In general, employees make benefit elections during open enrollment and are then bound by those elections for the plan year. The presentation notes one of the primary exceptions, a qualifying event. A major life change, such as marriage, divorce, birth, death, relocation, or loss of other coverage, may permit a mid-year election change if the event satisfies plan and legal requirements. The presentation also reviews owner participation rules, which are especially important for small businesses. Sole proprietors generally may not participate directly, although a legitimately employed spouse may sometimes participate and cover the owner as a dependent, subject to compliance considerations. Partners and partnerships generally follow a similar rule. More than 2% S-corporation owners generally may not participate in Section 125 plans, and their spouses are also excluded. By contrast, C-corporation shareholders may participate. For LLCs, the result depends on how the LLC is taxed and structured, so tax and legal guidance is especially important. To conclude, tax-saving benefit plans can provide significant value to both employers and employees, but only when they are set up with the correct core documents and administered properly. A Section 125 cafeteria plan can reduce payroll taxes and expand employee pre-tax benefit choices. HRAs offer flexible reimbursement strategies for different employer sizes and health plan structures. The WRAP SPD helps satisfy core disclosure obligations. Transit, parking, and educational assistance plans add further opportunities for tax-efficient employee benefits. And finally, proper administration, eligibility rules, election procedures, and owner participation rules all matter to overall compliance. The bottom line is this: the right plan document is not just paperwork. It is the legal foundation that makes the tax advantage possible.